Thank you so much for joining us. I hope that you've all had a wonderful day so far. Thanks again for joining us at the Sustainable Business and Social Impact Conference. Today we're at a panel called Debt Equity Impact Investing, a capital spectrum choice conversation. It's going to be a great panel. I'm glad that you all can make it. Our moderator today is Kathy Clark. Kathy is a professor here at Kirkwood and also has an illustrious career in impact investing and is involved with the P-Lab, Peers, SJF Institute, Investor Circle, and we're very happy to have her moderating this conversation today.
Thank you, Michelle. Michelle is the one who got us all organized, so first thanks to Michelle for putting it all together. So welcome, we're excited to have you here at the panel today. We have a fantastic group of panelists. The topic here is really looking at how enterprises and funders come together to create successful relationships. And so what we thought we would do today is as you know, the field of social entrepreneurship has grown and the field of impact investing is maturing. I'm not sure I would call it grown yet. There's a lot of different tools available, financial vehicles that investors can use, from debt, equities, loan guarantees, and there's a lot of structures that those investors decide to organize themselves around. And entrepreneurs have a lot more choices in terms of how to find a fit for the path that they want to be on and to find appropriate stakeholders to work with on that path. So what we thought we'd do today was try to expose a little bit of that process under the scenes. It's very easy to go to somebody's website and kind of see what they do. It's much harder to see, well, what are the questions that they actually ask of an entrepreneur, and what are some of the struggles and lessons that entrepreneurs have had in trying to do as well. So I'm really pleased that we have a fantastic array of people on our panel. We have two entrepreneurs. We have David Nicola, who is a student here at Kirkwood, many of you know, who is starting up a business and will tell us a little bit about that. We have Paul Sansone from Better World Books, which is a 10-year-old company and has a great deal of experience in this process. We have Sean Moore of Acumen Fund and Jennifer Pryce of Calvert, and Amir, I'm going to forget your name. Kirkwood, thank you, of Citi, who are all on the investing side. And we're going to let them tell a little bit more about their backgrounds first, and then we'll get started on the panel. So I'm going to take 2-3 minutes each on kind of what you do and your perspective on this issue.
Okay, great. Dave Nicola, second year MBA. The two aspiring entrepreneurs, probably the best way to term it. Two organizations that are not yet incorporated, but hope to be in a few months. Working with Jack Boutel, who's a first year UQA and joint degree MEM. The two organizations are Ag Impact Fund, which is a real estate, private equity, sustainable and organic agriculture investment fund, and Venture Farming, which is a business that launches and sustains sustainable and organic farmers. And the two businesses are actually very, very related, so we can probably get to that at another time. But the business model for the Ag Impact Fund, real estate private equity fund, buy land, lease to farmers. Why do you do that? Transition from seasoned farmers to new farmers, transition from conventional agriculture to organic agriculture, and increase working capital for farmers, which are historically very, very working capital constrained. Venture farming is a different business model, but also makes money via lease structure, and it is not huge landscapes like the impact fund would be, but it is smaller landscapes, 20 to 40 acres, in which you do intensive vegetable production and other production, and you are taking farmers who cannot manage and run their own operation, but have enough experience to work in a collaborative environment with shared equipment, shared resources, etc., to get them off the ground and eventually put them on a farm that the Ag Impact Fund owns and leases to them. So it's two steps. We like to think of ourselves as advancing sustainable and organic agriculture in the North Carolina region. That would be our social mission, with obviously sort of the holistic economic, social, environmental positive impacts that result from advancing those causes. In terms of funding landscape, obviously, because we're not incorporated yet, our primary funding has been through grants. Jack and I were fortunate enough to be recipients of the KC Prize last year, so that allowed us to pursue this over the summer and actually come up with some of these ideas So the next step is more grant money, pilot project, and then depending on which business it is, there could be either government support, loans, or actually equity capital from aligned, potentially impact investors.
Great. Thanks.
Thanks, Dave. Hi, everybody. I'm Paul Sansone. I'm the Chief Financial Officer of Better World Books and class of '92 Fuqua alum. I yearned to say Case alum, but it wasn't even existing when I went to school here, so maybe I'm like an honorary Case alum.
Absolutely.
Yeah. But Better World Books has been around for 10 years. I've been CFO of the company for about 4.5 years, and we have grown from starting a local book drive at the University of Notre Dame by 3 college students who wanted to help fund literacy programming efforts at a nonprofit in South Bend, Indiana called the Robinson Center, and basically had noticed that after they graduated, went back to the bookstore at Notre Dame and said they have all these textbooks that they wanted to sell back, and the bookstore would go and give them $1 for it or $5 for it. And they scratched their head and said, I spent $150 like 4 months ago on these books, so I don't want to give me $1. So they tested all these books from all their friends, put it up on, I think at the time it was half.com, and they were selling them for $50 or $60 because other campuses were actually using those books. So they said, well, geez, there's arbitrage in this book thing, so why don't we do a book drive on campus? And they approached the Robinson Center and said, we would love to do a split book drive for you, 50-50 on proceeds. We just need space and an internet connection. And they said, we'll have this empty conference room. And from there, the company got started. They actually did a book drive at Notre Dame. They raised $20,000 for the Robinson Center in 1 semester. And then won seed funding from a case competition at the University of Notre Dame that they coined the Irish Angels. And they won $7,000 of funding. And fast forward 10 years later, we've used many different types of funding to get where we are now. We're a $65 million a year enterprise, social enterprise. We're a certified B corporation, so we've been for-profit, for good since our inception. But all along the way, Irish Angels funding right at the outstart to angel debt, angel equity, small business loans, then regular lines of credit with personal guarantees, then more angel equity, then mezz debt, then venture capital round that was split mostly between a venture capitalist, a group called Good Capital based out of San Francisco that led the round, but then more angels afterwards, and on and on and on. So in 10 years, we've kind of run a little bit of the gamut of how to scale and grow an enterprise using different type of funding vehicles to reach our vision. So I'm looking forward to the discussion.
Great. Not a Duke alumni, unfortunately, so no cheer. I am a Duke fan, Duke basketball fan. I work for Acumen Fund, which is a global social impact venture capital fund. I'm on a senior portfolio associate on the team. Been with him. We're just coming up on 3 years. Spent most of 2011 setting up our office, our newest office in West Africa, in Accra, Ghana, with a colleague, and now work back on our New York team. We have offices in Nairobi, Kenya, which serves our East Africa region, and India and Pakistan. And basically, we, Acumen Fund, we're a 501c3 nonprofit based in the U.S., so we take in philanthropic capital, but then turn around and make debt and equity investments in early stage enterprises in developing countries that are providing what we deem critical goods and services to DOP populations or bottom of the pyramid. So we operate in 6 sectors: agriculture, education, affordable housing, energy, water and sanitation, healthcare, which is the one I'm most focused on. And we've been around for about 10 years, since 2001. And I think we really kind of started, the first couple of years was kind of just getting feet wet and understanding what impact investing was all about, and the sector was really young at that point. And Kathy knows better than anyone probably even before that. But you know, I think we kind of started investing as we invest now, probably like 2004, 2005, where we really started to build up our portfolio. But we've invested $80 million over 10 years in about 70 enterprises. And basically, we deem ourselves kind of patient capital. So we understand the markets that we operate in are very nascent, if not developed at all, both The products the businesses and the products they're providing those lending markets, and also just in the general context of developing economies and developing markets. And so our investment horizon is probably anywhere from 7 to 10 years. And we're actually a really interesting point in our history right now, because we're actually this year kind of focused on seeing a couple of successful equity exits, which is kind of the proof in the pudding of, does Acumen Funds model really work? We're investing in these early stage enterprises where traditional venture capital isn't willing to go, and can we bring them to financial sustainability and actually have an exit where a strategic or another commercial investor comes in?
I'm Jenn Pryce. I'm with Calvert Foundation, located in Bethesda, Maryland. And funny, Paul, as I was hearing you say good capital, we own a piece of good capital. So we own a piece of you. So we got to be careful here. Which was an interesting piece of light bulb going off, and is very illustrative of Calvert Foundation, of our history, our breadth, and our depth of experience in the impact investing space. We've been around 17 years. We birthed out of the Calvert mutual funds. I don't know if people are familiar with the mutual funds. Yeah? Okay. So they are a leader in socially responsible investing around the public equities. And really we're looking at more positive negative screening, shareholder advocacy. And one of the wild founders there, visionary Wayne Sylvia and a few of his friends, truly in a hot tub one night said, we can do better. And they decided to take 1% of the mutual fund assets of each of their funds and put it directly into communities. And so that's when they began lending to CDFIs, community development financial institutions. CDFIs are very special in our world in the U.S. If you're not familiar with them, they're the conduit that capital makes it to the ground in communities. Small business loans, financing charter schools, healthcare clinics, they're indispensable. They're a network throughout the country, about 2,000 CDFI loan funds, banks, credit unions. That is about today where we place 40% of our money. 60% of it does stay in the U.S., 40% of it travels abroad. So we are a global provider of debt capital, where Sean was saying we're patient equity, we're debt. So we are patient debt, flexible debt, but we only do debt. How we raise our money, foundation is a misnomer, we're not endowed. We actually sell a note to the public. And this is a very special thing about Calvert Foundation, because it's a retail investment product, the only one of its kind, because it clears through DTC, which means it's electronic clearing, which means financial advisors can easily take this security, put it in their client's portfolio, and have it look like a financial investment around fixed income or cash management is usually where they put it. So very easily accessible, very easily to transact. We've raised about $1 billion of these notes over time. Right now we have 235 raised, and we have invested in communities around the world. We also have an off-balance sheet team, and that's called Community Investment Partners. It's a wholly owned for-profit subsidiary. It's a registered investment advisor. They do fund management and asset management. We have about 150 or so assets under management there, and together then we manage about $400 billion of assets. We also incubated a donor advised fund on our balance sheet, which we have spun out into impact assets, and that's where our investment in good cap starts to come in. So we have been really a warehouse, a vehicle for testing new products in the impact investing space. We've been one of the thought leaders over time in the impact investing space. And so I'm going to pass it to Amir now, because I can keep going, and that is where I should keep going right now.
Thanks, Jim. Excuse me. My name is Amir Kirkwood. I'm with Citigroup in a group called Citi Community Capital. Citi Community Capital is Citibank's division that's responsible for meeting its Community Reinvestment Act goals, and the primary way in which we do that is through lending and investing in affordable housing or alternative forms of community development. Historically, we were largely based in multifamily lending and investing using low-income housing tax credits as the sort of primary basis for activity. But over the last 4 to 5 years, a couple of changes have happened with our organization that caused us to take on a variety of more varied portfolio. The main thing that happened is that we were moved within the municipal securities division of Citibank and within its investment bank. So what that effectively did was shift how we looked at community development less in the form of just solely meeting a regulatory obligation and doing the approach that sort of came most easy, most credit, with the highest credit characteristics, which was affordable housing, to shifting our focus around the municipalities where we were, and sort of trying to come up with an approach that said, Mayor X of City X, we have a commitment to do, among many things, to do investing and lending in your community. What are your priorities? What are the things that are important to you? What are the things that impact your low-income communities the most? What are the things that are the stickiest economic development challenges? And let's identify, number one, what can actually be accomplished, who the partners that are necessary to help accomplish those goals would be, and then let's try to put capital together and structures together to achieve those goals. So it's a shift in how we've approached things, and it's allowed us to now focus on strategies around healthcare, around education from the community college level on down to the charter school level. It's allowed us to enter into areas like small business lending through partnerships around sort of using intermediaries to either equity investment intermediaries or CFIs, as Jenn described, as sort of facilitators of lending activity. And then it's also helped us to create just a more targeted approach to sort of addressing innovation in municipalities. So there's not always a set of priorities that a city has, or that community development partners might know need to be accomplished. But if you give them the flexibility of knowing that there is some capital there that can meet those strategies as they develop, it actually gives them the freedom to sort of know that they have partners around capital that can address specific needs in those communities. So Citi obviously has a bigger social responsibility and responsible finance goal. We have a foundation that does a significant amount of financing of financial inclusion products, generally centered around helping school-aged children develop accounts to eventually lead to having stable income and stable savings around college. We have a separate division called Citi Community Development that does small grant funding at a very local level, working largely with nonprofits and very specific strategies that those nonprofits have. But my division doesn't have the sort of foot within the regulatory world, and it's flipped within, frankly, the investment bank, and you need to be a part of generating goals in that investment banking program as well. We rely on a very small team of highly trained, highly developed, skilled folks, very much like you all, to deliver multiple billions of dollars of capital into about 60 markets in the United States every year. And again, that ranges everything from affordable housing to healthcare to fund that, fund investments around business strategies and things we don't know yet because the ideas are still developing. And again, our goal is not to set the priority as much as to be able to finance the priorities.
Great. So first observation is how interesting and sophisticated all of your fund descriptions were, right? That they're all kind of in different niches and stages. I'm gonna personally ask you a few questions, and then I'm gonna ask the kind of room to suspend some disbelief as we kind of enter into this conversation. But one of my questions is, of the three of you, how many of you actually make direct investments into individual enterprises? 2 out of the 3. Okay, so you're investing in intermediaries.
Yes, solely.
I just want to make that clear if everyone heard that. And then of the 2 of you, how many would either of you look at agriculture or books as a industry area? 1.
Agriculture in international markets.
Right, okay. So first of all, you realize, right, everyone's going to kind of get down into their little sweet spot, and it doesn't necessarily match up with what must we have. So we're going to suspend, assuming everyone were in the right sweet spot. Kind of what can we learn from this? So let's go back to the entrepreneurs now and kind of say, what are the essential things that we need to know about where you are in your development and your business model that you think relate to kind of what capital you might need next? You're pre-capital and you're very much experienced in
Right.
many kind of layers. So I'm going to ask you for creativity in answering the question.
Sure. Go ahead.
Sure. Well, I think that you have to break two businesses out separately. Capitalization of a fund is going to be very different than the capitalization of a business, whether it's a venture farming, agriculture business, or a business similar to Better World Books, where the ability to bootstrap your way up through different means is probably easier in the business as opposed to in the fund. Obviously, probably bootstrap the fund together as well, but it's not the same. So for a fund, you're
We have Amir at the end who will invest in that.
Yeah.
Direct as well. So we have two people who are doing direct. So go ahead, talk about it.
Okay. So I mean, for the fund, you want to come up with an aligned partner that's going to give commitments and then go out and sell yourself to get commitments to put the money to. For the business, particularly in venture farming, the one we're looking at, I think it's a combination of loans, a little bit of equity, a little bit of personal equity, and then government support through reimbursement programs for either individual farmers or farming operations that help you get up to the stage of doing one project and then leveraging to multiple projects. I would think it's not too dissimilar to what you described.
I think if you look at capital in total, it's a continuous process, right? So every time we do a strategic review, which we try to do internally every 90 days, we just kind of refresh it and talk about it as a management team. What are the priorities for our next big thing, right? So how do we fund our next big objective? We started from inception to now, we've had about a 50% CAGR annually, right? So we had a lot of organic growth that we self-funded, bootstrapped credit cards, et cetera, angel debt, angel equity, anything you can think of. But over that time, I remember the three founders were students and worked with one of the Irish Angels who was actually one of the judges of the case competition that I talked about. His name was David Murphy, and they went to, after the case, they won first place, and David said, hey, I do private equity in Atlanta. That's partially what I do in Atlanta. And he said, we'll help you. However, if you have questions, just give me a call. I'll be glad to help you at any step of the way on growing your company out. And so over a period of 2 years, they kept counseling with David, and finally he said, I see your growth plan, guys. You need a bank line of credit to fund your capital, and you need a real CEO, and you're not going to get one without the other. And he said, so I think you're at the point where now they've gone from $0 to $1 million at that point, and they were constantly having to fund out of their pocket, getting books for a book drive, and then selling them 4 months later when school started. So, and the net of it is that at that point, they called David back 2 months later and said, would you be the CEO? And here's a guy who had been in private equity for a long time, run companies, and he said, yeah, I would. And so if you look at that stage right there, that they knew that they needed to start to grow up with SBA loans and lines of credit. And what was their short-term objective on how much organic growth they needed to fund that organic growth, right? So even today, we look at strategically, what do we need? And we kind of put ourselves in e-commerce on some of these books. We sell, right, that's okay. And so what we talk about is life beyond books. We talk about, we've actually been a marketplace company. So, could we be the Amazon for good versus just Amazon? I mean, so there's all these kind of initiatives that now our executive team, which is kind of rounded out over time, said, what's the priority? What do we need for funding? What are the projects that are on the horizon? How do we fund it? And I'll tell Jenn right now, she's going to be extremely thrilled with her return from Good Capital, who's from Kevin Jones, who's on our board. They're going to be thrilled beyond belief on the return in their investment. And part of it is, again, it was a timed horizon investment, so it was a minimum 5 years that they had set as an objective, and so now we're actually at the 5-year mark. So what's our capital requirements going forward? So just a long-winded way, it is a process that takes time and it's continuous. It does not stop, right? So what are your objectives? How much do you need to fund them? What's the return on investment? So it's not so much a get to some point and then you're good, right? So I'm constantly talking to our bank about extending our line of credit. How much more do I get to work with, right? So it's a process.
Can I jump in and just take a piece that you mentioned and lift up as a illustrative example of that connection between you need a CFO or a bank line of credit, but one without the other, chicken and egg?
Right.
This is true. As a debt lender, and we look at an organization, they don't have good financial internal controls, where you can get reports quarterly, P&L, QuickBooks, whatever it might be, that says how you are doing financially, or you don't have someone that's a controller or CFO, right? The debt doesn't come. And so illustrative, we made a $200,000 loan to an organization called Delight that is an international, you know them well. We were one of the first debt pieces in there. And we structured our debt so you would get $100K today. We will release the second $100K when we get a CFO on board and have financial reporting that we feel comfortable with. And we didn't mean for it to be constricted. We meant for it to be supportive, for them to understand and for us to help them get to that next place of growth. So that's just a piece that I would lift up from the perspectives of someone who lends with debt, that having good financial internal controls, having a controller, having a CFO, that's part of the maturation, part of the process.
Great. I'm going to come back to that. So let's kind of take Dave where he is and freeze you at that beginning time. And then turn to these guys and say, tick off for us, what are the main questions that you would want to ask, assuming that Dave was in Africa instead of here. Assuming he's actually doing community development at America, whatever it is, right? Suspend all that, but at the business level, what are the other, besides that, what are the other questions that you would really need to answer to be interested at all in a venture at this stage?
Yeah, sure. So, and I think this is actually a pretty good example, except for the fact that you're here in the U.S. But other than that, so Acumen Fund, just go back a little bit. So we're a 501c3 nonprofit. We're backed by philanthropic capital. We have a mission of poverty alleviation through impact investing. And so the broader umbrella discussion under all this is what is social impact, who is an impact investor, and if you know the answer, I think you're lying, because I don't think anyone here there's not one answer, right? And there's not one way to define it, and the field is trying to figure out what it defines. So under that umbrella, I would say to you, I'd say, okay, great, you have this agriculture idea. Tell me a little bit about the farmers that you're impacting. What are their socioeconomic profile? What services or goods are you providing to them that they don't have access to right now? How are those services going to increase their livelihood? Is it going to be economic? Are they going to have more land security? Is it going to be a path to owning their own plot of land and farming? What is it? So in our agriculture portfolio, our mission is smallholder farmer livelihood improvement. And so that can come through increased income. It can come through extension services such as micro drip or increase to fertilizers and other types of inputs. And so that would be the real question for me first is does this hit our target market, and what is the impact on the target market? Secondly, I would, if that all checked out, the next question would be, okay, what is, I'd say you're a startup company, right? So you're probably a little early for us. What's your track record? What have you done previously? Have you worked in a business, similar business, and now you're replicating it here? Does your partner have, does he have experience here in the business? Typically we don't fund startups, but if the social impact that we're looking at, we think it's game changing and has the potential, that maybe we'll look at it to you. And that kind of then leads into what's your vision? What does scale look like? So, if this is going to impact 10 farmers in Durham, great idea. Impact, probably not for us, because we want to affect tens of thousands, 100,000. So what does scale look like, and what does success look like? And I think that would be the basis of the question.
Is there a minimum threshold of either revenue or profitability before Acumen Fund would invest, or is that not part of the equation?
Good question. It's interesting. So Acumen Fund are backed by philanthropic capital. We do early stage enterprises, and we don't have a hard, minimum amount of revenue or kind of time for profitability. So that's a bit of a gray area where we rely on kind of our professionalism and expertise. We have more stringent requirements on size of investment, and so from Acumen Fund we would do somewhere between $500,000 to $2 million is our investment range. Our average investment is about $1 million. But again, we're actually, this whole notion of stages and of types of capital that we're talking about here, we actually do have a small investment fund, so low return investment fund. It's only a $15 million fund. But that was kind of a friends and family thing that Acumen raised in 2009 to basically provide this follow-on later stage, still early stage company, but later stage almost growth capital, that when we found early stage enterprises and some of them succeeded to get to close to profitability, that they could then get some of this capital. And so we're looking more into that side of things as well, and that would be larger investments from 1 million to 3 million size, and then Acumen Fund Sweet Spot is going to be more like 500,000 to $1 million.
And are the terms the same? Is it all debt? Is there equity in the fund side?
Equity and debt, the terms for the investment capital fund would be more stringent than Acumen Fund's terms. Maybe not necessarily the terms, but the risk profile of the company and the projected returns, because just to be clear, the investment fund, we actually have a financial obligation to get money back to the investors. They're expecting a return. Acumen funds, when we get a partner gives us a donation, it's a tax-deductible donation to a nonprofit, and there's no expected financial return to our partners. So that's not to say internally Acumen Fund, we are trying to get our money back with a return. And so our theory, the whole model is based on we can be a more effective use of your philanthropic dollar, because if we invest it and we get a return on that in 5, 7, 10, 11 years, that's better than just a grant out the door, which we know we're going to see zero back.
Maybe I'll ask Jen to respond to that a little bit. Same question.
Same question. So in looking for early stage capital. Okay. So remembering that at Calvert Foundation, what we specialize is in debt. So we're going to be, when we would come in, and then I can talk about early stage too, because we've done some smaller investments. When we come in, is we want to see a track record of at least 3 years, financial audits of at least 3 years, minimum asset size, probably $2 to $5 million, for revenue size of a couple million, and a way to get repaid, so a cash flow that actually can repay debt. So we are looking for repayment. That is very important.
Do you need the cash flow to be historically
No.
proven or predicted?
Predicted. So no, not necessarily. A lot of lending that we've done too is balance sheet based, so full recourse to an organization's balance sheet. 2 reasons there. One is we've been lending to intermediaries over time, not just directly to a business, but suspending belief and let's just assume we're going directly to a business. One of our goals over time is not to take collateral. We want to keep the collateral, any type of other assets that organization has for other, perhaps not as patient or flexible lenders. But if we were to go earlier stage, one of the biggest things that we look at is management, in that people have experience, that they have a board of directors guiding them in a way that's functional and experienced. A lot of emphasis on management is put in our risk rating score. We have different buckets of financial, health, social is a big output, but let's just assume that's there. But equally, a third of the rating is on management, operations, and board. So it is looking holistically at the organization, and the management piece is very important to that.
Anything else you want to specifically address to an e-commerce business?
The e-commerce business. No, not necessarily. I mean, I think the e-commerce business is no different from us. We're not an asset-based lender. We would look at cash flows. We would look at management. It wouldn't be for us, oh my gosh, you don't have a building. Oh my gosh, you have nothing that we can secure but your receivables or your own house, so we can't lend you. We don't look at organizations that way. However, that's the difference probably between the lending or even the early mezzanine or equity investments Calvert Foundation would do and the traditional commercial.
Did Barrel Books ever go to Calvert Foundation?
No, I don't believe so. No, I mean, the rumor was that Greg Beans in Kirkwood linked up the capital with Barrel Books with an email introduction that said you two need to talk.
Yeah, we did make a loan the first book.
So we're proving that Mario
I think so. That's right, but we believe that the origination of Big Capital is involved with us.
So we did make a loan the first book. Yeah, when they started their social enterprise, we were part of the lending trying to that. So that business model, not as e-commerce driven, but still startup, a lot of the same characteristics.
So maybe I can connect you with his fund and kind of say, what would you, I'm stretching here, but
there are sort of hybrid situations where we effectively are looking into an operating company or investing in an operating company. But what we'll do is essentially it'll be asset-based lending, so more than likely a real estate trust or a real estate like a limited liability corporation would form purely for the purposes of acquiring and developing and with the intent to eventually manage or maybe recapitalize that real estate. But those are extremely proprietary situations. I'll give you an example of one we did in New York. It was called the New York City Affordable Housing Fund, and it was essentially, again, driven by a priority in New York, which was to keep these long-held affordable housing deals with deep subsidy that had their subsidies starting to roll off from going into the private market. And New York City, it goes to the private market, you never see it again. So what we did was we worked with a local developer who had experience in the affordable housing space and said, look, here's a pool of money. You go out, you acquire these properties, we'll price this debt, or we'll price the equity and even provide you some debt at a level that allows these properties to be affordable as affordable at levels where the income of the families were roughly, let's say, 80% of the area median income of the level. The developer then went out and went through the acquisition process, identifying subsidies that they could find, and essentially managed the properties as if they were his. Everything from construction on through to the property management stages, and then it reached a recap to go out and recapitalize the properties and pay us back through that strategy. But in looking at that, we still have to look at the operating company itself. What is this developer's history? What experience has this developer had in this core space? Have they had experience with successful exits of these type of real estate assets, or were they limited only to properties that they could kind of buy and hold for an extended period of time? So for us, those are kind of hybrid ways where we can get at kind of being a direct investor, but it's still, kind of like ring fence the assets such that if things go sideways, we can claim the assets and then begin treating them as if they're our own.
We'll go back to Paul for a second, because you've had so much experience from the entrepreneur side. Two questions. One is kind of as you move through these different kinds of capital raises, what do you think was the hardest stage to get through? And what surprises did you have or lessons from that?
Great question. So I used to work at Cisco before Federal Books, and before that it was a company called Scientific Atlanta that was acquired by Cisco. The president of the division, I was VP of Finance, and the division was pretty good size. And he and I would talk about capital. And one of the things he was pouring into was, Paul, you need to raise capital when you don't need it. Right? When you need it, you're at your worst. Right? So I started with Federal Books in 2008, and to that point we hadn't been profitable. And at that point we had a need to extend our credit line, but we didn't have the track record that Jenn talked about, where the cash flows were not predictable. So I had stepped in as a CFO and had to gain, and we talked about the challenging time was trying to build confidence with our key bank, which is, we started with LaSalle Bank, which is a Midwestern bank that was acquired by Bank of America. So LaSalle gave us our first line of credit for $300,000 after completely embedding themselves to understand what we did. It was a very odd, unusual.
Does that feel intrusive?
Well, I wasn't there for that, but we loved it because they could actually understand and think about if you guys wanted to, I mean, I don't know if they can opine on it, but we basically got securitized through used book inventory. So they allowed us to borrow a line of credit against used book inventory, which any sane person would probably say you are insane to do that. But they got to know how our business worked so much that we had gotten those books through.
How did you get them interested enough to get that close?
Because they took an interest in the company and they were fascinated by it, and the relationship started. And I don't even know exactly how the relationship started. This is probably 2004. But they took time. There was a relationship manager who took the time to walk the warehouse and see. And we have a 300,000 square foot warehouse. At the time, it was about 200,000 square feet. It's the biggest airport hangar you've ever seen, full of books. And today we've got about 4.5 to 5 million books in this warehouse. At the time, it was probably 1 to 2 million. But the point was that she gets like, now what happens here? We get these books donated to you from library systems, and then what do? We take them and then we put them up on the web. And when we put them up on the web, the ASP of every book, the average selling price is more like $8 to $9. And it only cost us about $1 to get them into the warehouse. Oh, okay. So I see margin, right? I can see, the light bulb went off with her. Her name is Jenn. She's still a fan of Federal Books. She's actually, right? She's moved on to, so LaSalle gets acquired by Bank of America. She moves on, but the relationship continues. And so me coming into a difficult situation where we hadn't been profitable was trying to get their confidence and trust. Get their confidence and trust that there was oversight. And I'm like, guys, if you can give us some more line of credit, we can expand in these other areas. And let me show you our sample size on payback. If we expand in these new areas, we can get inventory. So we, for example, might buy inventory from a thrift Goodwill or something that sells it at 5 cents a pound. Well, we have proprietary information on what sells on the web, and then we can take those 5 cents a pound and book away is about a pound. We can make that 5 cents $8 or $9. Right? So you can demonstrate what the return is, but it took, I think they were happy to see me because I was the first CFO in many years at the company, and so they could relate. We could talk a language, but then it was trust, confidence, and hitting your numbers. So we we still have to monthly report our numbers to them. But now the credit line of $300,000 is $7.5 million. Okay, because we built up that trust over a period of time, and now I have as much capital as I think I need, to fund our operation. So it's literally that when it was difficult was when the operation wasn't performing as needed, and what you want is predictability of results and trust in them.
In terms of then what came later, was having that experience with that bank helpful in the next kinds of funding that you get? And I wanted to slip in my other question, which is, have you always had aligned capital, or kind of do you flip back and forth between aligned?
Okay, it's a great question. Great question. So the bank, I'll start with the bank. So $300,000 in 2004. When I joined, it was like $2 or $3 million in 2008. And then just continuing to grow that trust out, because after a while, them seeing returns, they were actually, even 2009, the economy was still very tough, but they had an appetite to say, look, for your type of lending, what do you need? Right? So we had built up trust over that time, so they were actually saying, what else could we do for you? And lower interest rate, lower interest rate, right? Whatever it was. But and so there's also, so for e-commerce companies, let's go back to the company, we're e-commerce, we have a credit card processing business that we need on the back end. Oh, well, who will competitive bid for that? Well, it's a lot of different banks, and Bank of America is part of that bid process, right? So we could actually give them more business if they competed and won our credit card processing. So, and they did, and it took time, but they did, and that was new. It was a win for them, and that was a win for the relationship manager, not just the lending group. This was a relationship manager turned it over to the credit card process. See, this company we got that. And then we bought that campus that I talked about. We actually were leasing it. And I know, you never hear about companies buying their property, but it was such a reduced rate. It was so accretive. I'm like, we could walk away from this building in 3 years and have made money. That they said, well, we'll finance your mortgage. Right? So it was kind of like this just continuous pattern of growth with the bank that allowed us, and Bank of America is a great company, but it is not a social lending institution by any stretch of the imagination.
But it has all these diverse offerings.
Absolutely.
That you're able to ride.
Absolutely. So when you look at good capital, completely aligned in our venture capital round, completely aligned.
Can you say a minute about what big capital is?
Yeah, so let's talk about big capital. So a B corporation that focuses on social and environmental venture capital funding, and that's their single thread. They're impact investing. Right? So they're Years Pioneer, if you guys know about this stuff on UAB, they are kind of a poster child for impact investing in the venture capital space. They're not huge, but they have targeted investments that they make. And so in 2008, they led our Series A, first ever. So we bootstrapped the company for 6 years, Series A round, and completely aligned to the point where they've changed the company on a little bit on alignment. I'll tell you what happened. In the actual capital round, they said, you guys are growing tremendously. We're going to help fund more growth. How does Mission ever survive exit with your company? We want to make sure that Mission survives exit. So jointly, the company, Good Capital, restructured the cap table to actually put 5% of our shares in an ISO pool for our nonprofit partners. So we actually have ISO shares, stock options, that we granted to our nonprofit partners that work with us on getting us books. They actually have ownership in the company. And that was good capital's input. Like, how does, Ben & Jerry's is a phenomenal organization, but there's always debate about, well, what happened with the Unilever acquisition? Did mission really survive exit? And the folks at Ben & Jerry's are awesome. They'll tell you, yeah, we had input. We had actually impact within Unilever going up to change how Unilever acted. But Kevin Jones, who's the principal of GoodCap, said, how do we make sure mission survives exit? So we carved out 5% of the company, and now our key nonprofits that we work with actually in ownerships, they get options in federal books, and have that conversation with the CFO of the nonprofit, saying we're giving you stock grants, and we get private grants from the foundation or individuals, but you're getting stock options, right? What's this? How do I got this? Yeah, right. So anyway, a lot of having that aligned capital is very good, so you don't have to explain social enterprise. We also believe that our story is good enough that we can go outside into traditional capital because the business model scales. And so you can have those conversations with a Bank of America or traditional capital folks. And we're actually, in 2013, we're actually going to try to do a B round. And we think we have enough requirements internally that say, wow, we can really turn this from a $65 million organization to $250 million to fund these things. So, we're going to get with the Citi guys afterwards and figure that out.
So there's another thing that you talked about, which is interesting, which is the intense personal relationship that you had with the bank that became B of A, and then later, now we're in a competitive bidding situation where there's different people giving us deals and we got to get to pick and choose. I want to take that issue to the three investors and kind of say, who are you competing with for the best deals? Are you in situations, some of the time, all the time, none of the time, where there's enough of a marketplace for that to happen, and how does it affect what you do?
I'm happy to go first.
Yeah.
He's talking about competitors. But it's interesting because there's pressures on, I think, banks that make it very difficult for them to be primary investors in social impact type strategies. We're fundamentally regulated piece, and regulators don't look at what we do. They don't look at a community-based investment or an agricultural farm-based investment any different than they look at an investment in Walmart or a loan to related companies or a large real estate investor. So often the challenge with large financial institutions is that the capital charges are going to be the same. The Basel II regulatory costs are going to be the same. The amount of the rate spreads are not going to be much different between what you're doing at a community. And effectively what you're often doing with community development or social impact investing, if you're lending at rates that are designed to allow them to function in the space where they need to, is you're effectively taking a sort of a tax internally to allow for you to meet your social obligations. So what's one of the ways you offset that tax is, to Paul's point, if all of a sudden they have another line of business that they offer, you go for it. Particularly if it's a lower cost line of business, then you definitely go for it. And because you're effectively getting an opportunity to subsidize with the will that you're. Yeah, exactly. So it's very much a strategy. I mean, a lot of what we try to do with municipalities is we're going out and we're investing or seeking partnerships with those municipalities around social investment strategies, because there's a lot of business that we want from the municipality itself. So there's revenue that's earned from those municipalities, revenue that's earned from getting on board large corporate investors and getting them to understand that social impact investing it matters to them. So you can have a partnership with GE around energy efficiency on lighting or something like that, and we're helping to finance a savings to nonprofits or a savings to small businesses. There's things that we want from GE, obviously, and there's business that we want from GE. So it is understanding what is it that you as an institution have to offer beyond just the core social activity that you're trying to achieve, And it's also being able to sell that proposition to partners who don't necessarily on day one recognize that they have the value to add to a social investor as well. And sometimes they're more willing to listen to another big boy or big girl on the block versus listening to the actual target of the social investment itself.
It's interesting because we have two distinct sides of our business. How we raise our capital is part of our business, and then how we deploy it in the form of loans to organizations. In the money out, the deployment, when we start to see heavy competition, it's usually a very good sign that the more commercial or standard, more efficient capital markets are coming into that piece of business. And to us, that's victory. So for example, charter schools. We did a lot of lending with charter schools. Now a lot of the local banks do that lending because they've kind of come to the point where the track record of repayment of that asset, that kind of sector space, the perceived risk and the real risk that come together. And it's not as risky as they once thought. They also have the skill set inside to analyze it. Like the piece of Paul's story that's really amazing to me is some relationship manager took all the time to understand the business model. Yeah. I just cannot believe that because there isn't very many of those business models out there. Yeah. So it's one thing if you're in a big bank, if you learn charter schools or healthcare clinics and how they work, because there's a lot of them down the road. There's not a lot of better world books coming down the road, even if you learn that business model. So it really was stunning to hear this person really taking that interest, which is awesome, but unique.
Yeah, very unique. So she spent a lot of time. Yeah, spent some time at the warehouse. And one anecdote about the story is that she got, she learned about the business model and got convinced that there was scalability in it. But then she did her homework, which was she said, okay, if we start with a line of credit and I'm lending to you against used book inventory, then I want you to get a third-party valuation by an asset valuation firm to give me some comfort that what you say you have is what you have, right? So she did her diligence, and the lesson learned for you guys if you're looking for capital, expect. So we were like, wow, we have to pay for this, but we had to convince her, and it wasn't a choice we could make, and it wasn't pleasant, right? But we had to pay for a firm to come in and understand the value of the inventory and say, so how am I going to analyze this? How many SKUs do you have? And they would say, well, I've never done a SKU analysis for 2 million SKUs, so help me out. And so if you shut the lights off one day, that's what the banks want to know, right? If I shut the lights off and I have to come in and sell this stuff, what will I do? Well, you keep it on the web for 3 months and then you bring in, remainder men to come in and buy it for 2 cents a pound. But we had to spend a lot of time with that valuation firm to get the bank comfortable that they had done the diligence. So it's just, again, it's part of the process. They understood the model and then said, let's take off our diligence pieces, which includes something like a valuation.
Yeah. And I guess just continuing the other half of our business, though. So in the money out, if commercial banks are coming in, that's victory to us, and we move away. And a funny story, one of the first interviews I had in a community development financial institution with the chief credit officer, I walked in and she had books stacked all around her office. I was like, wow, she's really an academic person. It's like collateral, mom and dad. That's where you securitize books.
That's the last thing my banker wants to do.
Oh, it was great. It was a printer in Philadelphia. I'll never forget that vision. I went like, oh, so this is
you are smart.
Anyhow, the money in, we're still unique. This is where, our mission is strong, very unique. What we're really aspiring to is educating financial advisors, educating institutions, educating individuals that they can make investments in line with their values, that there's products, there's access paths to do that. And so again, though, the more products we see come on that have different return and risk perspectives, because ours is very low risk, low return, so that's just one piece. If you're putting an asset, kind of a lens across all your investment portfolio, that's only one piece of it. The more products we see come on the market, the better it is, because then more people can get engaged, they can find a way to put their investment assets into this type of work.
So Sean, both the competitive question and then also kind of what has gone wrong in your process. You guys want to add another question to it?
In terms of failures of this? No, competitive. I think Acumen Fund institutionally shares the same vision as Calvert, that if our investees are attracting commercial capital or even other capital than Acumen Fund, that's a win. That's a sign of success. that's a sign that the industry is growing, that the enterprise has gotten to a point where other people are interested. Having said that, I mean, I think there is a bit of a debate, like I was talking about earlier, about impact, and there's all these studies out. I forget if JP Morgan, 290 impact investors, and we're kind of looking around and who are all these people? But we have, so just to give a quick rundown, like our peers would be like, Debt Stuff, Calvert Foundation, we've co-invested. She mentioned D-Light before, which is actually a good example that we can talk about a little later, but there's Grassroots Business Fund, LGBT Philanthropy, Root Capital does all debt, Bamboo Finance, Grey Ghost Ventures, Omidyar. These are just some of the names that are in kind of our realm of doing similar stuff, and we see them on deals. And it's actually interesting, one of the deals we looked at a while ago, and we mentioned in public health, Embrace, which is entrepreneur out of Stanford, and they did a low-cost infant incubator. And we looked at that deal, and we ended up passing on it because the valuation that they wanted was just, we couldn't really do it at the valuation we wanted, and think this was a good investment. And maybe if there weren't other seats at the table, other investors at the table, we would have more negotiating power to get it down. Maybe we would have thought, the social impact here is so great. No one else is providing capital. We want to provide capital. Let's try to make this work somehow. But I think it was it Koza? No Koza, the Silicon Valley entrepreneur, put a bunch of money in. I think Omidyar as well. And that was really interesting. That was a competitive, bid in the impact investment space, and that's great. That was a unique kind of investment that we did with Kirkwood. So and then failures. To be honest, so I'm sure people have heard Jacqueline Novogratz, our founder, talk a lot, and she's kind of all about failures and saying we have to fail and we have to share our failures. And the way I look at it is, if we're not failing, if all our investments are going well, we're just lying to people and telling them what we're doing. Our whole story is where Acumen Fund goes to where other capital isn't going to go, because it's so risky, it's so early stage, there's no public infrastructure, it's developing markets, and if we're making like 4 times our capital in all our deals, I don't think we're really doing that. So I think we have to fail, and we can fail because of our capital being philanthropically backed, where part of the impact is learning what doesn't work, changing a business model, investing in a business model that has learned from something that's failed, or supporting an entrepreneur that failed but now figured it out and is going forward. And so there's definitely been a couple, and actually now it's really interesting. We're 10 years in, we're kind of at a point where we actually have to say XYZ's investments are failures, and we're cutting loose from them because we don't have the time and resources to just keep plugging along with something that's not really going.
How long are you patient?
Exactly, how patient are you? So, but this is kind of the gray areas that we all work in, and this is where it comes from working in the field and being experienced in relationships and who to stick with and who not. But that's my view on it.
Great. Let's turn it over for questions.
So my question is around pipeline. Building up a pipeline of investments. How do you at what stage do you come into a potential portfolio investment and kind of take a look at them, and then how do you kind of build up that pipeline of potential investments through relationships or whatever else?
Just quickly, our Acumen Fund, our model is we have teams in our country offices, so East Africa, West Africa, India, Pakistan. We feel that that's our model. It's really important to have local presence so they can have networks, advisors, understand the market. So, our team is running around on the ground at conferences doing that. Me being here right now, I was in the public health space, and there's this whole SEED initiative, and Bob, who's from the engineering school, all he does is innovate medical devices for the developing world. Wow, I'm glad I was in that room, I'm doing that business card. Let's talk. Yeah, but so I think it's networking, it's conferences, it's, luckily Acumen's been able to build the brand. In Calvert, we get a lot of inbound submissions from business schools, from students, from conferences. And then in terms of how we invest, again, I think we're not at the angel startup phase, but we're kind of, past proof of concept, maybe a pilot, but probably pretty much past the pilot phase and kind of early stage capital to expand.
Can I say more?
Actually, someone got to do it.
Oh, sorry. A lot of the discussion has been around kind of there is super niche funding available within the impact investing space, and I guess in the impact investing space, and for an entrepreneur wanting to do a sustainable business, how is that connection being made? I mean, there's so much money available. There is money available, but how are these connections being made? Is it entirely network based, or what kind of business is kind of being done to get people through, that next pipeline, that next stage to, we don't do that kind of investing, but we know the people who do. Like, where does that happen?
Wow. So you're speaking about saying there's tons of inefficiencies here. This is where we can go a lot of way to improve for a lot of reasons, but one is I think we all use this word capital, just blanketly. I have capital, you have capital. But capital can be so many different things, right? And so you go online and you just, type in even venture fund. Some venture fund money is more philanthropic, some really wants a return because they kind of took the word venture from the Main Street markets and put it into our impact space, and it didn't translate the same. So I think there's a lot of floppy use of language that sends people in circles. And as a result, I think there's a lot of ways we can improve here, and if we did, the cost of capital, I would argue, to the end user would go down. Because, we actually are only 80% self-sufficient. We have to fundraise for 20% of our overhead because there's inefficiencies throughout the system still. We have not, to Kathy's first point, I think, the almost mature impact investing space. I think when we hit maturity, some of these inefficiencies will work themselves out. So there is a big, deep, and formal network that goes on. I will call Acumen and pass deals on. We'll work together on deals. I'll meet people at conferences. It is really, I find some of the entrepreneurs that end up succeeding are the ones that are just really dog-eared about going after call after call after call after call, because it's just that informal and still that sloppy. That being said, there is some accelerators, as you probably all know, like the Reasonable Institute or Equity Green, and these type of opportunities for entrepreneurs to latch into a pipeline. But even then, when I talk to the unreasonable people, they say the most successful entrepreneurs coming out of the program are the ones that follow up on all the opportunities, all the kind of mentor opportunities, all the leads. Similar, it was you who said that, come to Atlanta for that first call with Better World Books. And it was just, following up on Murray in that first book in the work.
I think one of the things, actually, let me ask it a little bit differently. Is it a problem that there's not sort of impact or aligned capital at later stages of the market? And we've seen sort of huge amount of sort of energy around early stage and sort of starting to be more mezzanine stage. Does it matter that there aren't more social impact aligned private equity funds or investment banks or sort of at those later stages of the exit? Should we care about that? Is that the next stage in this evolution?
It isn't. Well, it's an awesome question because we're at that point, and we actually. I think it's. And to answer your question, I think it is the next step in the evolution. So the folks at B-Lab, I had a conversation with them about. There's probably 10 or 15 certified B Corps that have gotten to scale. 50 million and above in rev. Right. So how much?
I one of them here yesterday.
Yeah. Right. So you see, there's these. Some of them are now being acquired by strategics, but where's that later stage? That later stage growth capital, which might have to come from some of the large institutions, right? So where they've got an appetite for deals that are in the $25 to $50 million range, right? So something more significant. I think that's the next phase. We've started to get to. It is completely inefficient. That word is so correct, and there's so many different conferences and so many different areas. You just got to be kind of literally aggressive in pursuit to find out where can I get married up with the right group. I think it's the time is you're going to start seeing this later stage where companies have actually scaled to some point and now need that next stage. Because again, we do 65 million, but our CEO and me and the rest of the team are saying, how do we get to 250? Right? What are the things when we scale, our impact scales. We can create so much more impact as we scale because we have the model baked in.
But follow on this question, does that need to be mission capital or can it be the capital that sees your business?
I think it's both, right? So you have to take so much. So anytime I've talked to a traditional VC, Okay, you have to spend the time to let them understand what social enterprise is about, what we're about, and then you have to get past this light bulb thing that says, so you could take down your impact a little bit and put more on the EBITDA? You could do that, right? And you have to go through that conversation and say, no, it's part of our DNA, it's part of the reason why we get books in the first place, it's part of our supply chain, it's part of our mission, it's part of our we wear a white hat. We get so much lift from this. It could be some area that's flexible, but we don't necessarily believe we need to be to give double-digit growth rate, double-digit EBITDA. So you have to have these. So the traditional guys say, what? They just have to get educated. Where when you're preaching to the choir, like a Kevin Jones, a good cat, it's the opposite conversation. How are we measuring impact this month? Who are we making impact with? Are you telling the stories of the impact that you're making? Right? These are the conversations we have with Kevin, who's on our board now, who's the chair of Good Cap, versus when we have the conversations with the other folks who have not even heard of social enterprise. It's an education process. But if you have a good enough business model, they get to, okay, I can see this.
And it's interesting because on the other side of it, where the money in is, and you see these reports of $50 billion sitting on the sidelines waiting into impact. There were some outrageous number, right? $5 billion.
120 billion.
120 billion.
Yeah.
So these people go to SOCAP and they're like, where are the deals? And they come to me or to you and they're like, where are the deals? Because the deals at SOCAP are not what they're looking for, actually. They're looking for you.
That's right.
And there's no place for those deals in that investor to meet up yet. So I think there's a missing piece in the spectrum, too, that is not being fused together. And you're starting to see some merchant banking.
Who can fill that need?
Well, there's merchant banking groups showing up right now. So people that have seasoned experience, like Amir and I, we could do a merchant bank.
That's
what's happening.
You kind of said it perfectly.
Yeah.
I think you tackled it very well as well. On the institutional side, the entire infrastructure of institutional finance is just not designed for it. The plumbing is not designed for it. The retail networks are not designed for it. The education of the bankers and the brokers and everybody, they're just not designed for it. They see mission-driven, and they punt to my group, the CRA-focused part of the bank. And the problem with that is that the CRA-focused part of the bank would be a regulatory obligation first and foremost, hopefully with some P&L attached to it, and that's our goal in Citi. But it's not designed really to sort of say, we're really a mid-market banking group that's smart enough to get at how to take this company that's got $25 million in revenue, that could have $100 million in revenue, to that level without looking at it solely in traditional metrics. And so there are merchant banking. One of our clients in Citi is a merchant bank called Next Street Financial based in Boston. And their whole model is built around providing advisory services to businesses. That are SBA-defined small businesses, which means you're anything from $2 million to $50 million in your annual revenue, so pretty wide range. But then also adding to it what they call growth capital as well. And so there needs to be more of that development in the market, because I think those are the folks who still are willing to take long passive positions on debt and equity, but at a higher scale, and can bridge that just fundamental gap that's there on the institutional side.
So let me just add something from ours. So we've done some research on the entrepreneur side recently, mostly domestically. And I kind of see two patterns emerging for people in your shoes. One is you certify yourself and you say, we will not compromise this. This is in our DNA and this is who we are. You either you work with us or you don't. And then the other piece is I see people just saying, we're just like everybody else. Forget about this impact stuff. We're going to do it, but we're not going to talk about it. And we're going to play with the mainstream financials because they don't want to hear about this and they're going to discount us if we talk about it. And then the survey that we did of impact entrepreneurs domestically in the U.S., what we found is the only ones that even participated in the survey that were old and big were B Corps. The rest of them kind of said, we're not going to identify with that stuff anymore. They do when they're young and then they kind of grow out of it.
Wow.
To that point too, I'd add too. I mean, we talked about entrepreneurs and the investment side. You know, there's a third leg to this, kind of the industry side, and I'm sure all these acronyms have been thrown around, but like IRIS, Impact Reporting Investment Centers, the GIN, Global Impact Investment Network, GEARS, Global Impact Investment Rating Standards, Systems. Almost.
You got IRIS, I was just like.
Yeah. And so there's like there's a third, the third leg to this is that the impact investing industry is still relatively young, and the industry and the structures within it are still growing, and so all those things are kind of feeding into how do we actually define social impact. I think that's that's a much larger question from this right here, but at Acumen Fund we do a lot of work internally of where are we having impact? Are any investments in certain sectors having more impact? Will there ever be a point where we can understand that an investment in a clean water company is more impactful than an investment in a education company? Who knows if that's ever going to come? But or is there going to be a social impact stock exchange at some point where people can put their money into companies based on stock exchange that incorporates social metrics? And so that's the third piece, I think, of this part. That I'm sure people in business are really interested in entrepreneurs and investing, but that's the industry piece. There's still a lot of organizations that are building the industry and capturing it more.
It's one of the things that we talk about here. We talk about careers and impact investing. We say actually being an investor is actually the smallest part of the marketplace right now. That we look at advisory and infrastructure as the places where there's actually the most opportunity, and it requires a lot of different skills that happen to be business skills. That makes sense. But let's have one or two more questions, unless you want to jump in on that.
No, that's okay.
Okay. Yeah. Yes, you.
For either Jenn or Amir, if you guys do see later stage deals that are like private equity buyout type deals with an impact focus, would you look at doing acquisition financing for those?
We would say yes. A couple different ways we look at it. We have obviously certain limitations around where we'll look at deals in the markets because of our regulatory side of what we do. But if it fits those regulatory boxes, then we can engage ourselves in that.
Yeah, we would look at it too. I think the thing that you need to be sure is that it was a continuing mission-rich opportunity. That the buyout wasn't creating it into a purely financially driven organization. So it would be an impact. That's primarily.
Have you a question back here?
Well, we kind of touched a little bit on the difference because other components, so maybe advisory services or when you're putting in a stipulation that you need to hire a CFO. Can you speak practically about when and how in the diligence process does the need for extra support advisory service factor into your investment decisions?
Sure, yeah, I think that's actually one of the biggest learnings for Acumen Fund that we're dealing with right now is that I mentioned to someone, a couple years ago a business would come to us and they had great vision for social impact, and it was, I think it was LifeSpring, which is a maternal healthcare company in India, and great vision, great service, and they were going to open, whatever it was. These aren't the right numbers, but 12 hospitals right off the bat in the first 2 years, and they had their first one out, and their first one wasn't even profitable yet. They didn't have the model right for one hospital, but they wanted to expand 12, and we gave them a chunk of money to do that. And looking back now, it's like, well, we should have given you money to get one or two right, and then let's expand from there, And so that's our learning. But baked into that learning was in the diligence process, okay, you want to do 12. What does it actually need to get to 12? You've got a great CEO and entrepreneurial division. Who's the COO that's going to bring you to that? Do you have a team that understands how to do? Are you going to construct these things? Who's going to project manage the construction of them? Where's that still in your organization? And so that, I think, is what we're doing now, and that should come in the diligence process, where we bake into our investment. We just started doing this actually. Okay, we think this investment is going to be a high priority for us in terms of the resource needed to commit by the relationship manager, because there's no CFO right there, and in our 100-day plan we have put a CFO in 3 months, and so we need to focus on that. And maybe someone doesn't have that already, and it's going to be a lower.
Great. Well, this has been a remarkably rich conversation. Thank you to all the panelists for coming in and sharing your expertise with us. Michelle, did you want to add a few words?
Yeah. Well, first off, let's just join me in thanking our panelists. We are on a bit of a tight turnover for the last session of panels. In this room, there will be a panel on microfinance in America. There's also a panel on technology in the developing world, and the third panel on Jenn as a community development case study. So we hope that you join us for those. And I'm afraid that it's because of the tight turnover, if you do have more conversations or questions for the panelists, then we might have that migrate out towards the hallway so that we can